speaking with Morgan's chief economist, Michael Knox. Michael, equity investors have been put through the ringer so far in 2016. Volatility is high, confidence is shaky. What exactly is going on out there, and is it as dramatic as some of the popular financial media would have us believe?
What's really been happening is a series of disappointments in US earnings. US earnings peaked all the way back in the third quarter of 2014 at $29 per share in terms of operating earnings. And then they declined in the first two quarters of 2015. What was then expected to happen was a recovery in earnings in the third quarter and the fourth quarter. The problem is that those recoveries in earnings, which were forecast by analysts, just didn't happen. So 2015 third quarter earnings were expected to recover about $3 a share. They didn't recover at all. The earnings for the fourth quarter, for example, were expected to recover to $29 a share, which would have taken them all the way back to the peak of 2014. They didn't recover at all. And in fact, they're around about $25 a share, and they are by a small margin making a new low for the cycle. So we've had a series of shocks to international equities markets, particularly the US equities markets, because of a failure to launch, a failure to recover in US equity earnings. Now, where we are is that earnings this quarter are expected to be stable, and then they are again expected to recover in the second half of this year, 16, all the way up to $32 a share by the end of the year. Now, if that occurs, then we'll have a significant recovery in equities prices. But after two significant failures, there is the problem of trusting analyst forecasts, and that's the problem we've got right now in markets.
And you forecast this modest recovery in earnings. What shorter term catalysts do you need to see to have confidence in that scenario playing out?
Well, then we get to the question is there a recession? Because if this decline in earnings is because of a genuine recession in the US economy, then gee, we're at the beginning of a bear market. But if on the other hand, we're not actually in a US recession and growth is just moderate, then we can expect that moderate growth to generate better earnings in the second half of the year, because we have a recovery in investment in residential construction, non-residential construction in terms of the building of high-rise office buildings and hospitals, and refurbishment of manufacturing facilities. So all of these things in a normal economy would generate a recovery in earnings as long as there's no recession. So then we get to the problem that everybody asks, is there a recession? And the data so far says no, there's no recession, and hence we should have that recovery in earnings.
There you have it, Michael, some very comforting comments there. Thanks for your time.
Thank you, Tom.